Okay, good morning, everyone. Welcome to the True Potential Do More Money podcast. We are on episode 65. Can't believe we've been doing that for this long now. I'm joined by a star-studded audience or panel, depending on the way you look at it. And I'm just looking at Steve is sitting in his hotel room. I thought I'd get that out now. He said he would give us a tour later on. And George and Jenny are joined in the office for me today, as we've been having some get back in the office days, which has been very good. So how is everyone?
Very well, thanks.
Yeah. Very well, thanks, Jamie.
Nice to be back in the office and see familiar faces and see some smiles and the new setup as well. It's I know me and Jenny are actually not too far away from each other in terms of we're on the same floor, but it's amazing how much space we've got here. Yeah,
it's fantastic. I think just to give our viewers a little bit of sort of insight of what we've been doing over the last 3 or 4 months. We've had the office refitted out to reflect obviously a lot more space, but also an operation of being able to work from home and work from the office. And we've been doing sort of small days, as we are for the next 2 weeks, of small groups of teams are coming into the office and really getting to sort of get to understand the space and what's available for them. And what's been quite good is we've been coming in. True Potential have tested everybody from a COVID perspective. So you go and get your test, and you go outside, and if you're lucky enough to be negative, you get to come back in. And then we kind of have a bit of a team meeting. But it's, for me personally, I've got a couple of teams that I look after. It's been good to really see people. And actually what's been quite good, I don't know about you, Steve, but I've actually met some people for the first time that I hired months ago.
Yeah, it's a good point, Jamie. We've had a fantastic year. We've had good, superb growth. So that has facilitated us employing more staff, and I'm sure it's the same for Jenny and George to a degree. Meeting some new faces and some very old ones, which have changed ever so slightly over the year. I'm not going to be rude and say how, but we've seen all different kinds of shapes and sizes, and I was in yesterday, and it was fantastic. Really looking forward to getting back on a more regular basis. And if people are passing by, please come and look at our new offices. And we'll be happy to give you a cup of tea and show you around. It really is, it's worth a visit. Yeah, it'd be great.
Yeah, the facilities are fantastic, very helpful. Right, George, if we can maybe start with you to give us a market update for the week. We've had an interesting week in the markets, looking at my portfolio every day. So just give me a bit of an insight and our viewers an insight of what we've seen this week in the markets.
Yeah, sure. I'll talk about, maybe kick off with the key moves, and then we'll take a look at what the key economic points were coming out over the week, and sort of round up with how your portfolio will have evolved over the week there, Jamie. So, last week was a really strong week overall for the equity markets. This week we've got quite a lot of economic data coming out. We've had central bankers speaking for the guidance around their policy there, but also company-specific earnings data as well. So as we've been discussing in morning markets, when you start to get the real data prints come through, you can often get a slightly mixed response within the equity markets overall. So over the week, global equities are off around 1% in sterling terms. If you look at the FTSE's down around 65 basis points, 250's down around 48 basis points. Smaller companies, or small cap as you may hear us refer to it, is up overall. It's up around 7 basis points. In Europe, the Euro Stoxx 50, which gives a broader overview of the various different countries and sectors within Europe, was down marginally. The S&P 500 was down around 85 basis points. NASDAQ, which is more tech focused, down around 90 basis points. Smaller companies taking a bit more of the brunt, but some positive data coming through overnight in Asia. In Asia, you had China, the CSI 300, and in Hong Kong, the Hang Seng were up around 85 basis points and 64 basis points together over the week. So that's putting Chinese markets in positive territory there. Japan, the data did dip slightly despite the improving outlook from supply chain managers. We've got PMI data, which often gives you that leading in outlook in terms of how companies are working in terms of taking on new staff, their order levels, how they're increasing their investment levels. So a positive outlook there from China as we move forward. We've seen a small pickup in implied volatility. You'll have heard to us refer to the VIX index in our morning market calls. It's quite US focused, that, but what it's shown is the volatility level has moved up very slightly, but we're talking about a very marginal level going from 16 to 19 at index levels. So Jeff will have pointed out on especially Tuesday's mono market video, this is to be expected as you're coming from a very low level of volatility and you start to get this earnings data come through. In terms of bond markets, you've seen generally a positive week there. So in the UK, the yield, which is available on 10-year government bonds, came in from 0.76 to 0.74. That's essentially reflecting greater appetite for government bonds, which is positive for the price there. The yield available on longer dated bonds, so if you're holding a bond with a yield to maturity of around 30 years, then they were down around similar levels. So again, you're seeing a positive movement in the price there. Across in the US, across the same maturity profile, so 10 and 30 year, again, you're seeing the yield which is available for US Treasury bond holders come in from around 1.58 on the 10 year to 1.55, and longer dated 2.27 to around 2.24. So we often discuss the shape of the yield curve in mono markets and how that looks. Generally, you've not seen a huge amount of change in that curve over the week. It has flattened slightly, but with the short end very much being pinned, but not a great deal of movement in terms of the shape of the curve. In terms of currency markets, you've seen the dollar broadly flat against a basket of international currencies. That was down around 20 basis points, but on the other side, you've seen some sterling strength come through. So sterling's up around 0.5% over the week. So taking that exchange rate of sterling against the dollar from 136 to a level of 139 at one point during the week. It's pared back ever so slightly. It's around 138 at present. In against the euro, you're around a level of around 115 at this point in time. In terms of commodity markets, you've had the oil price in terms of Brent crude, that's down around 2%. So it's trading at around $65.50 per barrel. We've seen some increased levels of stock around the world there, which is factoring into that. So greater supply levels can adjust the price level overall. Gold and silver both up around 1% over the week. But we're having a strong month in terms of the portfolios. Jamie, we've got the balanced portfolio. That's up around 1.8% month to date. We've got the aggressive portfolio, which is up over 2%, around 2.2% there. So some interesting data points which have been available, have been coming up. A few just to touch on before I move off the topic. One was just here at home, inflation. We've been discussing inflation on mono markets in quite a bit of detail. CPI was up 0.7% for the month of March, which with the index rate increasing slightly below the estimates, but generally demonstrate an increase in price levels. The key input to this was really fuel costs, which were up around 3% over the month, but also clothing costs, as well as people getting the cars and get their glad rags ready for heading out for the meal, which they were so much looking forward to in April and getting back into the office. So we've also seen activity levels starting to pick up. We've seen retail sales data come through there this morning, which is showing a 5.4% increase month on month. So we're seeing improving activity levels. That inflation number has picked up slightly. Remember, the target is around 2% there. We're expecting the rate to pick up to around 1.7, 1.9% next month. Some of that is a base effect, because if you remember this time last year, we were in full lockdown. Now we're in a different environment of higher activity levels, so you will see some effect start to come through, but not a level which is causing central bankers and policymakers concern there. In the US, we've had earnings data, which is coming through. So I mentioned when you get earnings print, you've got analysts who have got their own expectations. The real data comes through. It can sometimes move the markets a little bit. So just in terms of earnings growth in the US, Q1 is expected to be one of the strongest earnings recoveries which we've had on record. That revision has gone from around 15% earnings growth at the beginning of the year, went to 25, it's now at 30%. But just looking at some of the companies within there, you may look at popular companies like Netflix. Essentially what you saw was the expectations of new subscribers come in slightly relative to what analysts were expecting. What they were suggesting in that report was a lot of the demand for platforms such as Netflix has been pulled forward. So when everybody was in lockdown and watching Tiger King and The Crown and whatever it may have been, they've pulled a lot of that demand forward, whereas other companies are reporting stronger projections. So companies which are in, say, the semiconductor production industry, ASML was a company which was demonstrating strong expectations for forward-looking growth because of the recovery which we're seeing in manufacturing, essentially. We also had the ECB, so the European Central Bank, back in focus. They discussed two things over the week. One was lending, so lending conditions. So generally what they were seeing was a little bit of tightening in terms of banks lending to corporations. Now, that's not uncommon. We saw that within the US a few months back, and it was really just banks putting up higher thresholds because they wanted to make sure that they had that certainty in terms of the lending which they were offering and getting that money through to Main Street. But the other reason, which when you look under the bonnet, is you've actually got businesses who've got access to government grants. So they're using the government grants before they go to the banks. So perhaps not so unusual there. Also consumers in terms of their lending. You've got consumers with higher saving levels than what you would have over the longer term average. So perhaps not so much of a need to be going to the banks to lend when you've got these other facilities available. They also kept their interest rate levels at their current rate in their decision taking this week. They're keeping the bond purchasing program at the current rate. So that's a total package of around 1.85 trillion euros. So essentially what that's demonstrating is huge amount of support which is still there from central banks, and they'll keep on with that until they feel it's necessary or appropriate to start to roll that back. The other side, we've talked about vaccinations and those being the key to the next leg of the recovery. It's interesting just to see the developments which are coming through there. Major markets are still lagging behind, as we know, but the UK has around 48% of the population who've received at least one vaccination at this stage. The US is making big strides over recent weeks. They're at around 40% now. In Europe, they're slowly picking up the pace. They're at around 20% overall now. So quite a bit to digest there over the week. Bit of background in terms of the response from markets, but we'll continue to keep everybody up to date over the coming weeks how the earnings season does evolve.
Brilliant. Thank you, George. It's interesting the vaccine data. I saw this morning some data come out. Whether you've had your first jab, you effectively have a 60% chance of not catching COVID, and then after your second jab, it develops up to sort of 90s with certain jabs. So it's obviously made a difference. I think there's a couple of scientists saying we're actually coming out of the pandemic. It's now more of an epidemic. But it's interesting. Obviously, you're seeing that data come through daily. And hopefully that will, as I said, that will have an effect on the markets, as we know.
It's such a sensitive subject, Jamie. There's so much anticipation of it being the key catalyst. That's why you had such a strong reaction back in November from the more economically sensitive areas of the market when you had that first vaccination result in from the Pfizer, and then the 3 consecutive Mondays thereafter of positive testing results. That's why you saw the real economically sensitive areas of the market rally from that point onwards.
Yeah, I remember speaking to Chris Leyland right during the last lockdown, the first lockdown, when we were seeing sort of larger drops in the markets. He said to us, wait till we get a vaccine, you'll see the opposite, which is obviously exactly what happened. So I don't know if it was pretty obvious or Chris Leyland's just good at predicting things, but he was definitely correct in that basis. Okay, so in terms of the podcast today, we are it's a question and answer session. We've got a lot of questions come through from clients, and thank you so much for sending in your questions. It's some really interesting ones, and we'll try and answer them all today, and we'll pass them around the panel. Steve, we'll start with you. I know you've probably got a few holiday homes, Steve, so we'll ask you this question. And it's a question from Kevin, and Kevin's asked, we have a holiday home in Ireland, which we would like to gift to our children. Can we do this now? And will it take it out of the estate, avoiding IHT, so inheritance tax liability? Well,
thanks, Jamie. I was hoping you were going to ask me a question on what I'd watched on Netflix over the year, but I did watch Bridgerton, and I loved it. And I think it's a real shame that the Duke of Hastings won't be in the next series. And here's a point of fact for everybody. His wife is actually the daughter of Sally Webster from Coronation Street. So there you go. Oh. A nice northern connection there. Kevin, great question. It plays into, Kevin, the requirement for people to take advice when they're looking at 2 things here. When you're looking at your own portfolio. Now, your portfolio shouldn't just be your pension and your investment savings. It should be any property you have, any other assets and chattels that you've got. It does it makes sense to take advice on these because you're looking at periods in life. And if you're coming up, you're obviously talking about getting out of your estate, so you're probably either pre or just post-retirement. You will be well advised to take advice from an advisor on that. From my recollection and what I'm doing with my own portfolios. Thank you, Jamie. I do have more than one property, unfortunately, and yeah, when the time comes, I will gift it. Yeah, you'll have a 7-year rule on gifting it. The interesting thing, though, is using it and how you use your main residence. Your main residence can be a really tax efficient, investment, if you like. But you've got to be careful if you've got more than one property, how you allocate which as a main residence, etc. Because you can get caught out, and it would be absolutely ridiculous to pay either inheritance tax or capital gains tax on an asset when you really don't need to. Now, the beauty about our hybrid advice model is you can take advice ongoing if you like it, but you can take it when you need it. You can pitch in and out, and you can take whatever degree, whatever level of advice. You can use the technology to sort of assess your investments and savings and get useful hints and tips. You can engage with us remotely, as we've now learned to be really strong during the pandemic or the epidemic, Jamie, or wave 4 or whatever we're going to call it. So it's really interesting that the markets do read ahead, and looking at what the next wave will be and how it will impact us, I think is going to be very different to how we've been impacted in the past, hopefully. And we've all learned, obviously, how to express what the sort of mutations in the virus are. It is a mutation, not a mutant, I think. My wife always corrects me. I'm not going to walk down the street and meet a mutant virus, so I can come out of my hotel room. But you should get advice on your portfolio in its entirety, because how you allocate certain elements of it and how you take income from certain elements of it can be really important to you in retirement, because there's different tax rates on your dividend income. There's different tax rates, CGG applicable to main residences, I've said, and secondary homes. So, Kevin, long-winded answer, I know, and I'm sorry, and I managed to build in some of my wisecracks about Netflix, but you'd be well advised on this issue just to take an hour of an advisor's time and take some advice on it. But in my recollection, my take on it is, yes, you will be able to gift it, but you will be on a 7-year rule to get it outside of your estate. Yeah,
I totally agree, Steve. And a couple of points there that you made that we should bring out is there's nothing worse than being caught out, which at any point in life. So, but on that basis, but what I would say, just to go back to Kevin's question, it's worth just. There's different ways you can move it out of your estate, and there's different types of things, like put things in trust, and there's actually different types of trusts, which sort of I echo your point in taking advice to manage it in the right way if you're looking to sort of start gifting your assets to your children, so you can really understand what that actually does mean for your sort of tax liabilities when you do die. Okay, Jenny, we've got a question for you from Kieran. Kieran's asked, can I increase my regular pension contributions to have a more affordable pension?
Good morning, everyone. I'm not too sure if I've already spoke yet or not. I feel like I've been sat for so long, so I think it was just listening to George. So, yeah, Kieran, you absolutely can. There's quite a few ways in which you can instruct us to change your regular contribution. But I think the first thing, and to probably echo what Steve said, is that where possible, you should always speak to a financial advisor. Now, the reason for that is they will, kind of look at your outgoings versus your kind of your income versus expenditure, to truly understand kind of what your affordability is. You don't want to kind of commit to paying too much to find out maybe a month or two down the line that actually it's not an affordable amount for you to continue putting into your pension. So, your financial advisor will be able to take you through that. For all of our viewers that don't actually have a financial advisor, there's a great tool within our TP Investor site, which kind of looks at your income versus your outgoings as well. So you will be able to kind of go through that process with us kind of direct to see kind of what you can afford to put into your pension. But yeah, I guess the answer to the question is yes, you can. I think the other thing probably to mention is that where maybe you might have, a surplus income in a certain month, always remember that you've got the use of impulse save. So if you can't, kind of commit to contributing a certain amount extra each month, the impulse save functionality is fantastic for just putting in those extra little bits that you've got that you might not have every month.
Thanks, Jenny. Yeah, totally agree with the impulse save side of things. It's also worth saying that you can put regulars into any product on the True Potential platform. So if it's your ISA or it's your pension or even your general investment account, but totally agree with the affordability side. And also where it's worth looking from your pension point of view is that you won't be able to, if you, for example, if you're your age, Jenny, or my age, or George's age, you can't access any money from your pension. And Steve, I bet you know where this is going. You're probably okay to access money from your pension because you're over 55.
Well, I did see where that was going, Jamie. So thank you. Yeah, and I can still hear you and I can see you. So that's a real plus point, isn't it? Jenny makes a great point there. Regular savings are important, everybody, and it keys back into George's earlier point that we may be seeing a little bit more volatility in the market. We've talked in the past about volatility, and volatility can frighten people a little bit, but you shouldn't be frightened if your money's in the good care of the investment teams. However, when you're doing regular savings, you're benefiting from a thing called pound cost averaging. Now, I won't explain it in full here today because I'll put you to sleep this early in the morning. But however, if you want to learn about it, go online and talk to us about it, because what is happening is if the market drops a little bit, you're buying a higher number of units. When you're investing in a fund, you're buying units in a fund. So when the price goes a little bit lower, you're buying more units. So when it comes back up, you benefit from having obviously bought those units at a cheaper price. So, don't be scared by volatility. Regular saving. You'll never time a market, everybody, so please don't try. It's a fool's game. You will never, ever time the market. The best way to exploit volatility in the market is to play it at its own game and have a regular contribution, either through impulse save or set up a direct debit, so that you're contributing every month, every week, however you want to do it, and you're buying units at whatever price they are. And then when you get to the time that you want to cash them in, you'll be pleasantly surprised that the ones you bought at a cheaper price have the same value as the ones you bought at a higher price. So it's good advice to, again, use impulse save, use a direct debit, or consult a financial advisor or our tools online. Many ways of doing it.
Great. Thanks, Steve. Okay, next question will go to you, George. This is a question which seems to be coming up quite often at the minute. It's the sort of hot topic based on what's happening in the States, etc. But do any of the TP pension funds invest in cryptocurrencies? What are your view on currencies like Bitcoin? Do you think they should form a longer-term investment should they be part of a longer-term investment portfolio? And that question's from Philip and Mark. So two people have asked them questions.
Brilliant, thank you, Jamie. Yeah, interesting question. It is a topic which is coming up more and more. The short answer is we don't hold cryptocurrencies within the portfolios. Doesn't mean we've got blindfolds on and don't monitor what's happening in the markets, but I just think, from a functionality perspective, as a payment mechanism, there's many areas which are appealing. The Bank of England were discussing this week. They've released further details around their crypto task force to see how they could build an approach of cryptocurrency which would work alongside current payment mechanisms. But the challenge from an investment perspective is, especially retail investors, which is pension holders, is the volatility. So Bitcoin is one of the famous cryptocurrencies out there. If you're looking at the annual volatility over the longer term, it's around 82%. Now, what does that mean? Well, a typical equity market, if you were to look at a US equity market, which many people may think having all of your exposure within the US equity market is risky, you're looking at a volatility level on an annualized basis of around 16 to 18%. So there's a huge difference there in terms of that experience which you would feel as an investor in that marketplace. A commodity such as gold, you're looking at a volatility there of around 13%. So big differences. And for many retail investors, that type of experience would feel too uncomfortable to be involved there. So, we've had big examples of drops even this week. I was talking earlier about a small tick up in volatility. I was talking about the VIX index moving from 16 to 18%. Put that into context. We're talking about moves of 0.5% there. If we look at Bitcoin's moved down nearly 15% so far this week. So so it's a really for a retail investor, it can be a really challenging asset to incorporate to a portfolio. But to find out a little bit more, if you go to the blog, there's quite an interesting article which one of my colleagues put together called Coming of Age, which will just take you through both the how cryptocurrencies can work in terms of the real world, payment mechanisms, but also that volatility experience as well.
I'm just laughing because there's a tour of the office going around, as you can see, and like every one of them's waved to us, try to distract us. That was Dan Harrison, the first one at the back there, trying to distract as well, which obviously worked. So they'll probably be on their way up to you. They'll be on their way up to you now, Jenny, and you, George. So just beware. Thanks, George.
You think they'll be knocking on my door in a minute? There's an interesting point there that George made, and I think to expand on that a little bit. And we know the question was around cryptocurrencies, but the whole question, and the broader question around currency investment is worth exploring a little bit. Currencies are a really technical investment. And George makes a really good point there about retail investors. These things are not, even a dollar investment or a sterling investment, they're not for the faint-hearted. We've heard David in the past talk about, the importance of sterling and its value against, basket currencies and the dollar. It's really for the specialist type of people. We do hold types of currency investments in our funds, as George would be able to tell us, but it really is for the professionals, everybody. And I think cryptocurrency for me fits in the same basket, and a little bit more volatile than even normal currencies. But currency investment is best left to the experts, because you can get caught out and it becomes a gamble then, which you don't want to do. So, yeah.
That's exactly right, Steve. It's, the currency discussions which we have, as you know, Steve, with your background, we've got direct exposure to specialist currency funds which will take directional views, but they're absolute specialists in what they do. Thinking about this in terms of a broader portfolio, we have managers who have various different policies. Some do currency hedging, which actually just takes out some of the impact of currency movements on a return profile of an investment, because currency investing alongside fundamental investment can be a difficult task. So for retail investors, we like to take some of that volatility out of the market for them with hedging approaches.
Brilliant. Thanks, George. Thanks, Steve. Yeah, some good answers there. Okay, I'll move on. There's a question which I think I will take from Philip. And Philip's asked, when I start receiving my state pension, I will exceed my tax allowance because of another drawdown pension and one annuity pension. Is there any way of avoiding tax on the excess amount? Or if no longer need that income from one of the pensions, getting the question out, can I stop my drawdown? So yeah, so what I would say is you will have different phases in your life, and this, when we're doing pension and sort of retirement plan with clients, the major phase that you start to see is when you get your state pension. So that'll bring in an additional, typically about £8,000 into your sort of income amount. And if you're taking drawdown, and all of a sudden that £8,000 comes on top, it's effectively like getting an £8,000 pay rise. It goes towards it's effectively like PAYE. So it's important when you're assessing it and you get into these stages in your life where you say, right, I've got a final salary pension that's going to start on this date, or I've got my state pension that starts on this date. Speak to your advisor. We'll be able to tailor your income. So in this example, we could reduce your drawdown. So we can reduce the amount that you're taking out your drawdown to say, actually, what do you need? And look at how we can set that up in a sort of tax efficient way. So I'm doing this for a client at the minute specifically. And what we're looking at is how we can ensure we can take income from their pension up to their allowances that they're allowed, and then look at how we can use tax-free cash from their pensions to facilitate the rest of the income requirements needed. So hence paying no tax. So it's really just about, what I would say is, speak to an advisor when you're coming up to these stages in your life. It's very important, and just even that initial conversation can really make sure that you're taking your money as tax efficiently as possible. Great. Jenny, I've got another one for you from Sean. Sean's asked, does the growth rate I see in my account include regular contributions that I am making?
Yes, Sean, it does. So the great thing about the client sites that True Potential offer is that you can see kind of all the transactions going in. So regardless of whether it is a regular contribution, an impulse save, a transfer in maybe that you've brought across to us, all of those receipts will show or count kind of towards the growth that you see in your client site. Again, as mentioned, there's some brilliant features within the client site that allow you to kind of track what's not only going into your pension, but what's kind of coming out as well. So if you've got drawdown payments coming out, as Jamie touched on before, you'll kind of be able to see those going through, but also coming out. And ultimately, it will show kind of on a pretty graph kind of how it is growing. So I think the client site is very interactive. And I think it's a great tool to actually be able to monitor your investment. So yeah, you will be able to see it.
Brilliant. Thanks, Jenny. Steve, I think we'll kind of do a joint question. There's a good question that's come from Ian about investment strategy. So George will ask you, and Steve will include you in it based on your background with UBS. I think it's more about managing money. So there's a recent article on the 14th of April 2021 in the Financial Times bore the headline, "Investor Brace for a Shift, a Momentum and Value Collide." It quoted various factors including value, momentum, quality, volatility and size as being in play when investors make their decisions. To what extent do these factors influence TPP's investment strategies, and in what proportions? So George, I'll start with you, and then Steve, if you could add your thoughts on that as well, please.
Yeah, sure, Jamie. Yeah, interesting article. Essentially, what it was referring to was market styles. You'll hear us talking about sectors within investments, so technology, energy. You'll hear us talking about geographical regions, but another aspect of investment is to think about it in terms of factors or styles. So the article was really focusing on growth, value, and then momentum. So there's a lot of other factors out there. I think you mentioned size, you've got income, you've got quality, but there's just three sort of headline ones there: growth, value, and momentum. Now, growth has really been in vogue for the last decade. It's essentially a style of investing which places emphasis on the expectations of strong earnings growth to come through. Now, a lot of analysts have been sort of challenging this style because it suggests that at this stage, perhaps investors are paying a little bit too much for that earnings growth, which is expected to come through. And the famous names which you'll have heard us talking about is the FANGs, which is Facebook, Apple, Amazon, Netflix, and Google Alphabet, depending how you want to term them there. But they've really had that turbocharge during lockdown because essentially a lot of those stocks are really the only things you could do within lockdown, the Netflix, the Amazon, and so on. So working from home stocks, growth stocks, they tend to be captured within that overall growth profile. Value is more about finding investments which are perceived to be priced below their intrinsic value or undervalued. So essentially what you're doing there is you buy in with the view that the market price will move towards what's viewed as the fair value or the intrinsic value over time, rewarding the investor there. Many of the undervalued areas of the market at this stage are those which are a bit more economically sensitive. So we're more challenged in 2020. But as I mentioned in that introduction, I've seen that strong recovery start to come through since November, where you had that positive news on the vaccination. And when a market begins to gain a trend or form a trend and sort of progress in a certain direction, it's often referred to as momentum. And momentum in itself can be incredibly powerful. You've got to be quite active in terms of how you manage momentum because you don't want to get caught out there. But essentially what the article was referring to is you're seeing strong growth within, or I don't want to mix the terms here, but you're seeing positive performance within value, and it's starting to form a little bit of a trend. Now, you'll see that move about a bit. It's not every week that you're going to have value outperforming growth in this environment. We mentioned the vaccination rates being a key part of that. They are sensitive to that progression. But generally, you've seen value outperform value by about 11% since that point in November. Not all styles are going to work at all times, and that's why within the portfolios we do provide style diversification. So we provide diversification of, yes, the asset class, yes, a geographical region, but also those styles. Why? Because, as I say, they don't always perform. Not always one style will outperform at all points in time. They will move about depending on the environment. So we don't want to hold investors at the mercy of one particular one, but we do take a view on this, and at present what we are doing is expressing a tilt towards the areas of the economy which are more economically sensitive, so benefiting from the progression of the vaccination, from forward guidance in companies, and have been leaning into that part of the market, which has been evident as you see with the portfolio performance during that time.
Brilliant. Steve?
Yeah, really interesting. I mean, George eloquently again covers a lot of bases there. The important point for me when we're talking about style investing, excuse me, is diversification again. You don't want to get caught, and it's back to some of our previous comments. Fund management houses don't want to get caught either. So you'll read articles, they come up with phrases and they come up with acronyms like such as GARP, growth at a reasonable price. Now, is that growth investing or is it value investing? They try and play all the angles. But within our portfolios and our underlying fund managers, they'll be looking at style tilts, as George says. Momentum is interesting. Momentum can run ahead. So, again, don't try and time the market. You'll get left behind by momentum. But as fund managers, we want to make sure we're in the right place to exploit the pockets of momentum as they build in the market. George is right that value investing has been out of vogue for at least a decade now. A lot of really popular historical fund managers have built their names on value investing. The M&G group was built on value investing. Neil Woodford was built on value investing. I had to say, because I know you were all smiling thinking I'm going to go that route. Because it's been out of vogue doesn't mean it's gone forever. The way I look at it, growth investing is sort of the perception and the due to your analysis, the understanding of future income. With value investing, it's actually being in receipt of that income and using the dividends to grow your funds, etc. And it will come back into, the UK market is typically a value market. So, it will come back. So don't be left behind. The thing about markets at the moment as well, and in my lifetime, this has been a huge shift, and I'm not that old, right? But I've been around a while. The information flow is a multiple of thousands of times than it was. We can view our investments daily. In the past, you used to get a statement once a year. The markets, the analysis, the amount of information that's coming quickly through to fund managers and analysts is incredible from where we were back in the 80s. So, things can run really quick. So, you don't want to get left behind, because we want, obviously, your underlying investment managers to be seeing which way the market is building. And then some of it is almost like common sense. You're thinking, if value investing is about companies making a profit and paying a dividend, what's the economic environment we're in? Is that conducive to this kind of happening? And you can make your own minds up a bit. But again, and I keep saying it, don't try and make your own mind up and time the market. Leave it to the George and his colleagues, because markets do look ahead, and we try and look ahead with them. And again, diversification, we cover all the bases. We don't want to be stuck in one style. Neil Woodford, you don't want to get stuck. You need to diversify across asset classes, across geographies, across all different types of currencies, as we've talked about. Everything is in our funds. So I can't remember the name of the gentleman that asked the question, but the question is, very interesting article. It was we have it covered. Is it right?
You make a great point there, Steve, about that you've got a lot of information, but you've got to be sensible in terms of it's ultimately taking a step back and saying, well, what do I actually want to pay for this asset? It's all good and well. There's a lot of momentum in the market and a lot of herding, but actually, what do I want to pay for this? We've got the managers who will screen this in different ways, but there is a time where you have to just take a step back and make a sensible approach towards the valuation. That's what it comes down to.
Brilliant. Thanks, George. Thanks, Steve. We'll switch over. There's a pension question, which I'll take again. Question is from Ian. I have 2 pensions plus 3 final salary pensions from previous employers. Are there any tips on how I can manage my combined pensions as not to hit by the lifetime allowance, pension allowance, so as they grow? So there's some concerns from Ian, where he's got a number of pensions and he's wondering whether he'll obviously go over the lifetime allowance. I think the first thing to say, Ian, is the way final salary pensions work in terms of calculating lifetime allowance. And there is, depending on when you started to take your income, these can change, but typically it's a multiple of 20 times your income. So you find that you typically find that you don't tend to hit the lifetime allowances from your final salary pension. So it's worth just having a look at that. If you times them by 20, you'll be able to see it. The main one we see is where people potentially transfer from their DB pension into an area where they have $1 million plus in their pension, and that will give them a lifetime allowance tax charge potentially as they draw down. Once you're at that level, there's no way of sort of getting around it. What I would say is that the idea is speaking to an advisor and phasing your income, because you only charged above the lifetime allowance. And what will happen is when you turn 75, there is a sort of stop and the lifetime allowance charge is done there. But it's the idea of this is to start taking income. So if you start taking income sooner, then you're obviously not going to get as much growth in it. And that's what the lifetime allowance is designed for. But my view is if you're getting to that level and you've potentially got that from a DB transfer, there is ways of not sort of paying the mega tax of 55%. You can pay 25% if you take it as income, but it's kind of focusing back towards what Steve said multiple times, which is before you do anything, pass this by an advisor so they can once again help you and support you in terms of how you draw your income in the most tax efficient way, because it actually may be that it's best to leave your pension where it is because of that reason and take it from other assets. And so I would always say it's vitally important. Everyone's circumstances are different. We're speaking to advisors to make sure, are you going to go towards that a lifetime allowance? Because if you've got 3 final salaries, potentially not. But looking at when you are drawing your income, speak to that advisor and they'll be able to help you and support you through that. Okay, we'll do one final question because I think we've got them all. And I think this is another good one we'll share between Steve and George. Why is the FTSE not growing at the same rate as the Dow Jones index? in the last 10 years, ratio Dow to the FTSE was about double, now near a 5 times value. Part of the issue is currency valuation, but pounds dollars has not changed that much. What is the underlying reason? Should we have more in the US markets? And that question has come from Tim. It's a good question.
It is a good question. Shall I take the lead? I suppose the FTSE 100 essentially representing 100 of the top companies within the UK. That's ordered by market cap, so it's based on the value of the company, and the position is based on how that's changed over time. Just in terms of the FTSE 100, it's a basket of UK listed companies, but they're very much international. Around 80% of the earnings of the FTSE 100 companies are actually generated overseas, so it's quite an international index in that sense. But the Dow Jones Industrial Average, that's 30 companies which are US focused. That index is done on what we call a price change basis, so it's price weighted. So the biggest weighted managers are the ones who've seen the biggest change in price, not so much the overall value of the company. Within the FTSE 100, currency is a factor, especially if you look at periods of sterling strength. So after the referendum, this can be seen as a bit of a headwind to the index, because those firms who are generating their earnings overseas essentially have to bring them back to sterling, and they get less bang for their buck in that sense there. So there is a currency factor pulling in there, but it's probably more another factor to bring in there is just the composition of the two indices. So if you look at the Dow, you've got around 20% in tech. Now tech in the US has done over 500% in the last 10 years. If you look at tech within the FTSE, it's a much smaller amount. It's around 3%. Bigger parts of the FTSE market is areas such as energy, areas such as financials, which are more economically sensitive. And I mentioned that sort of momentum which you've had in tech performance over the last decade, essentially. So should we be holding more? Well, if we look at the US, we've already got around 25% in the balanced portfolio in US equities. We've got around 40% in aggressive, but no, that's not all just tracking the index. You can track the Dow Jones through different ETFs which are in there in the market. We're holding US companies on a direct basis, so we can sort of get away from some of the areas which we do feel are overvalued. We can play certain themes. One of the themes which we're playing within the US is a long-term view on healthcare. We've got the value themes coming through. We've got those growth themes coming through. So whilst we do, still hold a reasonable chunk within the US, we're playing this in different ways, and our managers are active in terms of that nature. So, in terms of where do we go from here? Well, the US is a key building block of the portfolios. At this point, what's been interesting in recent months is managers starting to see some better return opportunities outside of the US, so turning towards the developed markets, such as Europe and Japan, for future growth. So should we have more? Well, I think we've already had a good chunk in the US, and we've done very well out of that. But we don't want to sit in our laurels and hope for the best there. We've got to be active, and we've got to move where the return opportunities are. So quite an interesting question. Hopefully I've tried to just break down the difference in the composition there and why you've seen that difference in returns, but also our view on the US overall.
Yeah, it is a great question actually, because it sort of opens up a Pandora's box of where we go with it. If, again, it's a change in the markets. What we've seen is the fact that, the UK market has become an even more global market, as George says. The FTSE 100 is 100 companies listed in the UK, but the majority of their earnings are international, and not just US earnings, they're international, literally global earnings. If you were to look at the world and say, right, we should just asset allocate accordingly, to the size of the economies. I think George might correct me here, but the US is about 60+% of world GDP. So if you're just going to flatline it and say, well, we'll have 60% in the US and 10% in the UK, you get what you get. The skill of the underlying fund managers is to say, okay, right, let's just look at that. We don't want to just play the game of equal asset allocation according to global sort of size. We'll overweight the US and we'll underweight other areas. And I think, we have been strong US while the growth has come through. There is a line of thought as well that if you look at the UK at the minute, it is an undervalued market. So, a lot of people are suggesting people should increase their asset allocation to the UK. Again, it's something I'm not skilled at, and I've always sort of deferred back to the investment managers to make that choice. But it is a really interesting question. And again, I keep going back to it that, asset allocation globally was a much easier job 30 years ago, because you could kind of just divide it up and think, I'll follow the... Incidentally, there was always a really home country bias as well. People in the UK wanted to invest in UK companies, so they've been massively weighted to just the UK, which, was good in some years and really poor in others. And so now, as we've got a more ever diverse and global market and global trading styles, you can take advantage of what's happening in the US and the Far East and emerging markets. So again, it's having a well-diversified portfolio with skilled managers who can tilt the portfolio where they see, a particular market or style, or even a currency arbitrage. However they see it, they can play it. And but yeah, interesting question. I'll be thinking about it because I've been thinking, yeah, I should do about that.
Thanks, Steve. Thanks, George. Okay, we've got one final question that we'll ask, and I'll point this towards Jenny, because I think she'll definitely know the answer to this one, which is it's a question from Sean. He's asked, will St James's Park be the best stadium in the English Football League Championship next year?
Oh God, that's a question I get asked. I feel like I ask myself every day, because obviously with a football mad person living at home in Greg, I feel like at the minute he needs his crash helmet on every time the TV's on, with either, a rival game that are next to the relegation zone, or, Newcastle are playing. You need like child restraints on him. I hope not, for my sake. Not because I'm a lover of football, especially not Newcastle, but more so for Greg's sake, and then ultimately mine. But yeah, so let's hope they're not going to be.
So the household won't be very happy if Newcastle go down for Greg. I know how passionate he is about the football, but I don't know, Steve, you're used to relegations, so what's your thoughts on it?
That's cruel, pal.
Sorry.
Always been this, interesting. I wondered, as people started dropping out of this Super League, I wonder how long it would be before Bradford City got invited to join it. Not thinking, because we'd say yes, okay, we'd be straight in there. Outside this window, I can probably see St James's Park, so it's a fantastic stadium, and I think the way... I'm not going to waffle on, because it's people probably diss it. Last night when I walked out, some of the old sort of Edwardian and Georgian architecture of Newcastle was stunning, with with the Gray's Monument, etc. But then looking to the left, you have a fantastic example of modern architecture in the ground. The way it sits on that hill and dominates Newcastle. If people haven't been here, you should visit, because it's like a mini Sydney when you come in across. You see the Tyne Bridge, and the river looks stunning. And certainly, depending where you are, which way you go in the sunset or rising, you get a great view of it. And then you see St James's Park on the horizon. It's stunning. Yeah, so they won't go down this year. They're not now. There's 3 poor teams below. But it is. Come and have a look at Newcastle. It's a place to come and see.
Great.
After
you've been at Bradford. Yeah. No, it is. I don't think we'll go down either, Steve. But who knows? You never know in Newcastle. It is a journey, isn't it? It certainly is a journey.
Crash helmets at the ready.
Yeah, I was going to say, I wouldn't want to be in your house, Jenny, if we did get relegated. I definitely agree with you on that. Greg's not a bad loser, not a good loser. Is that right? Not a good loser. Right. Okay. We'll wrap that up now then. So we'll just have a quick sort of go around what the plans are for the weekend, and then we'll finish off. So Steve, are you You running this weekend? Are you cutting the lawn? Are you chasing the fox? What are you doing?
Bit of everything, Jamie, actually. My wife's working, and then she's working Saturday, and then she told me she's going to a surprise 60th for her sister on Sunday in Oxford, which is a 4-hour drive from where we live. So I thought, I'm going to Oxford on Sunday, but you guessed it. No, it's in my And yeah, I'll be chasing the fox, digging a garden, cutting the grass, missing my wife. You're right, if she's watching. And then it'll be Monday again.
What about you, Jenny? Any plans for the weekend?
Well, no, not really, to be honest. We've recently just moved house, so it'll be a bit of unpacking because I'm sick of living out of boxes. It's only been, I think, a week, and if I see another box, I'm probably going to scream. So bit of unpacking, bit of hoping that there's no nasty surprises with football if Newcastle are playing. It's really bad that I don't know if they know or not, if they are or not. But no, I think I'm just hoping for a little bit of sun. But then I think for me, I'm actually really, really excited for next week because it's TPI's return to the office days, Monday and Tuesday. So it's all welcome days back where we're going to get the team back in the office over those 2 days. So yeah, really, really kind of more so wishing the weekend away to get to next week.
Excellent. You'll enjoy that, Jenny. It's, for the last couple of days with my teams, it's been fantastic just to see people again in a safe way. It's been very good. George, you look like you're probably either running, biking, or maybe it's going to the getting yourself a bit of a suntan on the lounger. I'm not sure, but what are you doing this weekend?
Well, it was my first day back in the office yesterday, and I don't know about everybody else, but by the time I spoke to everybody, I was absolutely wiped out. I think, but it's the most sort of interaction I've had since the summer. So if anything, if today goes like it was yesterday, I'll be wiped out tonight. So it'll be an early night. I'm doing exams at the moment, so I'll be studying on Saturday, and then hopefully going to get to a beer garden for my first outdoor beer since the bars reopened on Saturday night. So fingers crossed.
A good tip from me for been studying exams for the last 3-4 years, George, is having a beer and revising at the same time doesn't work. So,
but that's the reward at the end. So if I get a good shift in tomorrow, then that's my aim.
Yeah, good stuff. Well, brilliant. Thanks everyone, and thank you everyone for your questions. Some really, really good questions this week. I think some testing questions as well. I would think everyone would agree. So thank you very much. We'll be doing another one of these in a few weeks' time. So please put the questions in and send them in via email. If you haven't already, please like and subscribe. If you're interested in terms of you subscribe, there's many videos that we do, morning markets. There's little sort of snippet videos that we do in terms of products and understanding products, as well as the podcast. So please subscribe, and that will give you a bit more of our content. You can also view these, so you can also listen to these via podcast on your Apple and your Spotify, if that's a preferred method. So thank you very much, everyone. I will hopefully see you all at some point. No, I won't see you next week, actually. So I'm on holiday. So I'll see you the week after. So thanks, everyone. I'll speak to you soon. Thank you.
Thanks, everyone.
Thanks.
Subscribing to True Potential YouTube channel is quick and easy. Simply go to your YouTube app on your phone, type in True Potential and press the red subscribe option. You'll then be notified as and when new videos are released.